In the final hour before the market closed, we detected an unusual trade worth $1.8 million on Huntsman stock, ticker symbol HUN. Looks like someone's hunting for profits. So in this video, we'll break down this unusual option activity to figure out whether this wealthy investor is bullish in buying, expecting the stock to move higher, or bearish in selling, expecting the stock to drop lower. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, giving them an edge to make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. And so, to level the playing field, let's dive into the unusual option activity to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, there was unusual option activity in the final hour before the market closed on December 2nd at around 3 p.m. when a series of trades all targeted the February 20 options at the 12 strike calls. Many contracts for these same call options were traded repeatedly, showing clear conviction behind this move. The pattern of transactions suggests this was not just retail noise, but coordinated positioning from a major investor. What makes this even more interesting is the timing and consistency of these trades. They appeared just minutes apart, which often signals algorithmic execution or a large trader spreading out orders to avoid detection. They were also being traded at the same price, 65 per contract. Keep in mind that options are priced per share, and each options contract controls 100 shares of stock. And so to get the actual dollar value, we multiply by 100 or simply move the decimal 2 places to the right. That means each contract costs $65. Now, is this investor buying or selling these options at this price? This data can be confusing, especially when you see both green and red here. But the color does not necessarily mean the options were bought or sold. Many people assume green means buy and red means sell, but that's not always the case. There's a lot more data to analyze before you can determine whether an option was actually bought or sold. That's why we always verify the data at a deeper level, something many other websites and scanners simply do not do. They automatically label green as buy and red as sell, which often leads to false signals, wrong results, and costly mistakes for anyone following unusual option activity. And that is why our deeper analysis gives us more winning trades than other websites. And in this case, our verification confirmed that these options were bought by a wealthy investor at $65 per contract. And so, to calculate the total cost this wealthy investor spent, we multiply the price per contract by the total number of contracts traded. And so, how many contracts did they trade? Because it's not just these contracts that you see here. There is more than meets the eye. That's why we always take a closer look at the data to improve our accuracy, increasing our probability of profit. So to find out how many contracts were just traded, let's first check how many contracts existed before this unusual trade was made. This is the historical data from December 2nd, the day this unusual option activity happened. And so, looking at the February 20 options at the 12 strike calls, there were 605 open contracts in the open interest. Now, if those contracts that were just traded on December 2nd are new opening contracts, then the open interest should be more now, adding to these previously opened contracts. On the other hand, if those trades were closing contracts, then the open interest would not increase. This data is very important to confirm because it strengthens our analysis, and that in turn increases our probability of profit. Because if a wealthy investor is closing out contracts or trades, it could mean they're worried about that stock. So maybe it's not the right time for us to jump in since they're getting out of the trade. On the flip side, if a wealthy investor is opening new contracts, it could signal an opportunity for us to start a new trade. So let's find out by checking the updated data on the option chain for the same February 20 options at the 12 strike calls. And we can see here that the open interest has now jumped to over 28,000 open contracts, a significant increase from the 605 open contracts previously. This clearly shows strong interest in these options, and it also indicates that this wealthy investor opened new contracts since these contracts were added to the existing open interest, increasing the total number of open contracts. This is why we always take the extra steps to verify the data at a deeper level. Many other websites and scanners simply flag every high volume options trade as unusual without filtering out closing trades. That's what leads to misleading signals, wrong conclusions, and unnecessary losses for anyone following unusual option activity. But our deeper analysis filters out those false positives, which is why we consistently find more accurate and profitable trades than other websites. And in this case, our deeper analysis confirmed that this was a new trade opened by a wealthy investor, not a closing trade. And with this kind of size, they're making a strong directional bet and putting real money on the line. How much? Well, let's do a quick calculation. Since there are 28,815 open contracts now, and 605 contracts were previously opened, we can subtract that amount to estimate that around 28,000 new contracts were just added. We round down because some of these new contracts could be other traders jumping in, including us and our members. But the majority of these new contracts were opened by this wealthy investor we've been tracking. So we can estimate the cost of their trade by multiplying this number of new contracts by $65, the same price as we saw on the options time and sales tape. And this equals a total trade cost of approximately $1.8 million for this unusual option activity. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so, if you want to get access to those lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. And if you join the membership through our website instead of YouTube, you'll also receive additional trade alerts by email because YouTube does not share your email address with us. So if you want more opportunities to profit, make sure to join the membership through our website. Keep in mind that our members also get early access to trades like this before anyone else, even before we share them with the public. So if you're tired of being late and want more time to act on these opportunities, just head over to our website, where you can see exactly which stocks wealthy investors are trading on Wall Street and when they're doing it, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? With that said, even though this trade carries higher risk, we still took it, but we used position sizing to manage our risk. As you can see here, at the 12 strike calls, since this was a new opening trade, we also bought these call options and entered the same position here, marked as POS, with the green color indicating a buy position. Because based on our deep research across multiple variables and data sets, this wealthy investor bought these 12 strike calls at $65 each, the same price as we saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile graph where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line over here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below the zero break-even line, as the share price goes down, this trade becomes more negative, more loss. And as the share price goes up, this trade becomes more positive, more profitable. In other words, This trade is going long bullish on Huntsman stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here, the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $12, the stock needs to trade above $12.65 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We do not invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here where you can also learn more strategies to increase your profits. Let us know in the comments. Do you think Huntsman stock will move higher or drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.